Alex. Okay, my name is Anthony Diazdi, and what we're going to do is we're going to go through the columns and the lines of Schedule J and try to make some sense of it. All right, so first of all, who files a Schedule J? It's going to be your 1A, 4, and 5A filers. They're the ones who are required to file the Schedule J. Now, when you're completing the columns and lines of Schedule J, you're going to express that in the foreign corporation's functional currency. Now, that's typically going to be the dollar. However, if the foreign corporation's economic environment, or should I say, the foreign corporation's books and records are kept in a foreign currency, then the functional currency of that foreign corporation will be another currency other than the dollar. So remember, when you're completing the Schedule J, complete it in the functional currency of the foreign corporation. Don't just assume that it's a dollar. All right. Now, when you look at the Schedule J to start with, you're going to see a little A, and it's going to say separate categories of income, and enter the category of income itself. That's pretty important because when you're completing your Schedule J, it goes by income category. Now, the Schedule J says refer to the instructions. There are no instructions to the Schedule J that helps you determine the category of income you'll be reporting on the Schedule J. Instead, you're going to have to look at the instructions for the Form 1118, and that will provide us with instructions as to the categories of income that will be reported on the Schedule J. All right, so what I'll do is I'll go through the relevant categories. There's a number of categories, but let's look at what you most likely be entering there. So 951A category, that's going to be your GILTI or tested income. So if you have GILTI, you'd write 951A. The instructions talk about foreign branch company income. That's not going to be relevant for purposes of completing the Schedule J. There is 3 other areas of income, which is probably going to be more relevant to most most individuals preparing the Schedule J. And the first one's going to be passive. Now, passive income itself, that's typically going to be your foreign personal holding company income. And foreign personal holding company income is a subset of Subpart F income. And what that is that basically if the foreign corporation is receiving passive income outside the United States in form of interest income, dividends, rents, royalties, that would probably be classified as foreign personal company holding income. Now, if the foreign corporation itself is in the active trade or business of receiving rental income or so forth in the country that's operating in that case, they may not be classified as a foreign personal holding company income. There's another income category called income resourced by treaty. If you're dealing with a situation where a treaty resourced an income for whatever reason, then you'd wind up going ahead and choosing resource income by treaty for purposes of Schedule J. There's going to be a category for Section 901J income, and that's going to be income received by the foreign corporation from a sanctioned country. I guess that would be such as North Korea or Sudan, or there's a number of others as well. And then finally, you're going to have your general category of income. Your general category of income is going to be any income that's not described. And that's typically going to be your Subpart F income. That also might be GILTI income that's been reclassified. Now, it's possible that a individual will have to or a preparer will have to have more than one Schedule J attached to a Form 5471. And that would wind up happening in a case where you have multiple categories of income. And if you have multiple categories of income, what you're going to have to do is write total in the category of income itself. That would indicate to the IRS that there is more than one category of income and maybe more than one Schedule J being filed. All right, so let's move on now to part one of Schedule J. And the first one, it asks you if you don't have all the books and records when you're preparing the form. Obviously, you don't want to be preparing the Schedule J if you don't have all the books and records. By checking that box, you're subjecting your client and yourself to potential penalties. So, I wouldn't, if you're in a situation where you're not able to prepare the return because you don't have the proper books and records, I wouldn't move forward. But anyway, that is on the Schedule J. If for whatever reason you don't have all the books and records, they ask you to check that box. All right, now, the part one to Schedule J, this is where you're going to have your columns and basically, in order to complete the columns, you're going to have to know a little bit about the PTIP rules. And Alex did a wonderful job discussing PTIP. But what I'm going to do is I'm going to try to kind of discuss it at a more basic level and kind of walk us into how the PTIP rules work for purposes of reporting this onto the Schedule J. So when you're approaching this form, you have an idea of where the PTIP itself might wind up falling on the Schedule J. So as Alex indicated earlier, the purpose of reporting PTIPs on a Schedule J is to wind up making sure that the shareholder doesn't wind up getting taxed again on an item of income, and that taxation could that second level taxation could wind up happening through direct or indirect ownership or chain ownership of another entity itself. So if you don't have your proper PTIPs reported on a Schedule J, you run the risk of having the CFC shareholder being taxed twice on that same item of income. PTIPs are also important for purposes of foreign tax credits. Different items of income itself, it's subject to different rules for purposes of foreign tax credits. So that's another important factor to consider when you're going ahead and you're categorizing your income, or you're putting that income itself into certain baskets. All right. So what I'm going to do is I'm going to take a step back, and I'm going to start off with how the PTIP rules look before the 2017 Tax Cuts and Jobs Act. And if anybody's been preparing these forms for a while, if you had a chance to kind of look at what the Schedule J looked like before the enactment of the 2017 Tax Cuts and Jobs Act, you'll notice it was a far simpler form. And the form itself basically only had three categories of PTIPs that you reported, all right? But for purposes of us understanding how to report that PTIP on the current Schedule J, it's important for us to understand where these rules come from, and then we can kind of talk about how these rules expanded. So the first category of PTIP, which is under 959C1, and that's going to be the PTIP attributable to investments in U.S. property. And Alex had a wonderful presentation, and he kind of talked about it. But that's under Code Section 956. And basically that's any investments in U.S. property, which would include intellectual property, a loan from a foreign corporation to a shareholder, patent, copyright, etc. All right, so that's going to be your first category of PTIP under 959C1. Now, 959C2, under these older rules, that was PTIP related to Subpart F income. Subpart F income was basically enacted by Congress back in the 1960s to basically prevent foreign corporations from deferring foreign source income. And then finally, you have your 959C3, and this is going to be your general income itself. So those are that we start off with those three categories. All right. Now, as Alex mentioned earlier, there's a number of PTIP categories that relate to Section 956. Now, if you're preparing the Schedule J, that's important to note because there's a number of columns here that talk about 956 or investment in U.S. property, which, because of Section 245A, it's not really relevant to a lot of us who is preparing these Schedule J's. So when you're approaching it, you can go ahead and we'll talk about in a minute on what category, what columns that you can go ahead and say, look, I don't have to worry about that because I'm not dealing with PTIP that they're asking about, which is PTIP, which is coming from a U.S. property type of a situation. All right. Now, after the Tax Cuts and Jobs Act was enacted, the IRS issued a notice. There was a number of proposed regulations and final regulations on which kind of affected 959. And as Alex also indicated, there's also some new proposed regulations that are out there. And so these rules will probably change in the future. But as of right now, and in order for us to kind of understand how to get through this Schedule J, I'm going to try to simplify it the best I possibly can. All right, so 959 C1 and 959 C2 PTIPs, under the regulations, they've expanded the 959 C1 and C2 categories. It went from 1 to 5 each. So now, when you're looking at your PTIPs, what you're going to have to do is you're also going to have to categorize Section 909 E&P that's related to Section 909 anti-splitter rules. You're going to have to go ahead and classify, as we discussed earlier, the 956 investment in U.S. property. You're going to have to go ahead and classify your PTIPs for 965A, 965B, 245A, the hybrid dividends, Section 1248, and GILTI inclusions. And you're also going to have to go ahead and categorize your PTIPs for hovering deficits as well, if you're relating what you're reporting a cross-border merger. All right, so now since we've got the general gist, the general rules of how these PTIP rules work, and by the way, you're also supposed to go ahead and shift these rules as well if you wind up having a situation where you have items of income that was related to U.S. income and so forth. But we'll get to that as we go through the Schedule J. All right, so let's take a look at column A. All right, so what is column A? Column A is 959 C3 E&P for post 2017, and that's basically going to be the current year's E&P for that foreign corporation. You're going to wind up reporting that under column A. All right, so if you have E&P, and this is, I'm oversimplifying this, but if you have E&P for the current year, that's going to wind up coming under column A. Column B, you're going to wind up reporting 959 C3 earnings and profits for post-tax year 1986 through pre-tax year 2018. So if you have E&P for those years, you're going to wind up reporting that under column B. For column C, you're going to wind up reporting 959 C3 earnings and profits for pre-tax year 1987. I have yet to come across a case where I've seen that. If you have, put something in the comments below. But if you have E&P for a foreign corporation, 959 C3 pre-1987, that's going to go on a column C. All right, column D. Column D, you're gonna wind up reporting hovering deficits and deductions, which basically took place when you had a foreign-to-foreign corporation non-recognition transaction. All right. So if you wind up having E&P taxes that are carried over under Section 381, and that's you'd wind up reporting that onto your column D. All right. The regulations have a number of really good examples discussing it, but unfortunately, we just don't have the time to kind of go through it. So now let's move on to column E's. So this is the example. So on column E, it's broken down into 10 columns, and 1 through 5 on columns 1 through 5 basically discuss E&P that is related to 956 U.S. property. All right. So unless you're dealing with a foreign corporation that had earnings and profits, PTIP from earnings and profits in U.S. corporations, you may not have to worry about completing categories 1 through 5. Now, categories 6 through 10, they're going to be identical to 1 through 5, but the difference is that it's going to be E&P that's not related to earnings and profits of U.S. property. All right. So that said, let's kind of go through it. Let's take a dive into this, and so let's start off with column E1 or E5 or sorry E6, and basically what that is that if you had E&P for the transition tax under 965, you're going to wind up reporting that E&P from the transition tax under 1 if it's related to U.S. property, and 6 if it's not. Column 2 and column 7, I think. That's if the CFC the foreign corporation will use this column if you wind up having 956B PTIP. And that's basically if you wind up having an E&P from one foreign corporation offsetting the E&P from another foreign corporation for purposes of determining the transition tax, to oversimplify it. All right. Column 3 and I think column 7, you're going to wind up reporting your PTIP, which it's attributable to investments in U.S. property that has been reclassified for purposes of your PTIP rules. Column 4 and 9, this is going to be PTIP that's attributable to inclusions under 959A GILTI, or for purposes of column 4, it's going to be PTIP that's been reclassified as investments in U.S. property under the 959 ordering rules. Now, the next column itself that we're going to discuss over here is just column 5 and column 10. This is going to be reporting PTIPs that are attributable to basically a couple different events. So the first one is if you had a PTIP that's attributable to a hybrid dividend under Section 245E2, and if it was reclassified as a U.S. investment, it's going to be under Category 5. If it was not reclassified as a U.S. investment property, it's going to be reported under column E10. So to understand how did we'd come across this, basically 245 Cap A, you're allowed, a foreign corporation is allowed a deemed dividend deduction for dividends, or DRD, that's paid out for its foreign source dividends that it's received from a specific 10% foreign-owned corporation. However, that 100% DRD dividend deduction is not allowed if that dividend itself that's paid from the other foreign corporation, if you wind up having a so-called a hybrid dividend, if that dividend itself gave rise to a benefit in that foreign country in the form of a deduction or some type of other tax benefit, in that case, you're going to wind up losing that 100% dividend deduction. And if that winds up happening, then that PTIP that wound up occurring from that in context of that payment, you're going to wind up reporting that under Category 5 if it's related to U.S. property, Category 10 if it's not. Now, where most people are going to wind up seeing this PTIP calculation would be under 1248. Now, what is 1248? 1248, it goes back to pre-2017 Tax Cuts and Jobs Act. And what it was is that prior to 2017, foreign corporations were able to basically have large amounts of E&P that were untaxed in the U.S., stored outside the United States, and then when a shareholder sold its shares, what 1248 did is that shareholder had to recognize that portion of E&P that was not subject to U.S. taxes. So when you sell a foreign corporate stock, it's taxed at capital gains rates. What 1248 did is it wound up kind of taxing that previously untaxed earnings and profits. So then that was taxed at ordinary income. Now you think with the transition tax, you think that with GILTI, you're not going to wind up having the opportunity to have E&P not taxed in the U.S. But there are still some exceptions to this rule where there's some taxpayers have that ability through their foreign corporations to still defer some of the E&P earned outside the U.S. and keep that away from U.S. taxes for at least for a temporary period of time. And how would that happen? Well, under GILTI, you have a 10% carve out, so to speak, where you don't wind up having that amount of foreign corporations E&P potentially subject to GILTI tax. So if you have that amount, that QBI, that amount is not subject to U.S. taxes. When a CFC shareholder sells its shares, you have to re-recognize that. Another way that you could wind up having a situation where you have to wind up recognizing deferred foreign source income is, as Alex was talking about earlier, about the 962 election. Now, the 962 election is a wonderful tool. It allows, in certain cases, a U.S. shareholder to be taxed as a foreign corporation for a portion of the foreign income that's being distributed to it. But there are two calculations to it. So when that U.S. shareholder winds up deferring, or let's just say, let me back up a minute, when that U.S. shareholder winds up paying, let's say, 10.5% on GILTI income, and winds up claiming a foreign tax credit, there's going to be a second calculation down the road eventually, and that second calculation will be taxing that person and as if it received its dividend from the foreign corporation, and kind of equalizes things. So if you did a 962 election and you sell your CFC shares prior to having that second calculation, 1248 will wind up kicking in. And then one final note is, in certain situations, when you do the 954 election at high tax exception, certain situations you're going to wind up having potentially a certain amount of foreign source of income that hasn't been taxed. So when you're preparing the Schedule J, if you're dealing with a CFC shareholder that sold their shares, the PTIP itself that's in connection with the sale of the shares for 1248, you're going to wind up reporting on most likely column 10. Now, there is one other situation where you can wind up having a reporting under 1248, and that is if you have one corporation selling CFC shares for another foreign corporation, and then let's just say you had an amount there for personal holding company income. So if you had foreign personal holding company income that for whatever reason was deferred, you'd wind up reporting that on column 5 or column 10. All right. So now since we've gotten, there's one final column itself, that's going to be column F. Column F, you're just going to basically wind up adding up the amounts for the columns itself. It's kind of self-explanatory. All right, so let's now go through the lines for Schedule J. So line 1, it just basically asks the filer to enter the balances of each column at the beginning of the year. So these balances should equal the amounts reported at the ending of the prior year for Schedule J. And if for some reason the balances are off between this year and last year, you're going to wind up reporting that differences on your line 1B. Okay. More importantly, let's move on to line 2A. So line 2A, I spoke earlier about splitting events under Code Section 909. And this does happen when you're dealing in cross-border type situations where you could wind up having, because of transfer pricing, for example, or differences between U.S. law and foreign tax law, you may wind up having a foreign tax credit splitting event. And what that means is that you could ultimately wind up taking a foreign tax credit, but because of the differences, either because of transfer pricing or differences between the law of the U.S. and the tax law of a foreign country, you're not going to be able to necessarily take that foreign tax credit in year 1, for example. You might wind up taking it in another year. So if you had a tax event, a 909 event where you wind up suspending foreign taxes for purposes of reporting it on a Form 5471, and let's just say that foreign tax itself was unsuspended in that particular year, then on line 2A, you're going to wind up reporting that unsuspended amount. Now, with that said, with line 2B, if there was a current tax that was suspended because of Section 909, you're going to wind up reporting it there. But line 2B talks about more than 909. If you have a situation where a client had a hybrid splitter arrangement. What is a hybrid splitter arrangement? That is, or I should say, you could have a hybrid split arrangement, or you could have a reverse hybrid split arrangement. But in any event, what the IRS is getting at over there in its instructions is that if you have a instrument that is, say, debt for U.S. purposes and equity for foreign purposes, or reverse, where it's treated differently under the tax laws of each country, then you may have a situation where you're going to have to suspend the foreign taxes that are associated with that hybrid splitter arrangement. So if you have a 909 situation where taxes are suspended because of that, or you have a hybrid instrument splitter event, that goes under line 2B. All right. I'm not going to go too much into detail on this. I think Alex did a wonderful job talking about this, and what he alluded to was before you do your Schedule J, do your Schedule C and your F and your H first, all right? Because what line 3 asks you is that from line 5C of your Schedule H, you're going to wind up carrying that down to line 3. All right. For line 4, if you're dealing with an EMP distribution from a lower tier foreign corporation, you're going to wind up reporting that on line 4. Line 5A, it's kind of a little bit of a carryover from what we discussed earlier about your hovering deficits. Basically, earnings that are carried over from a surviving corporation after an acquisition or an asset after an acquisition, so that you're going to wind up reporting that onto line 5A. And then line 5B would be any deficits from the surviving foreign corporation. So line 6 is you're going to attach a statement detailing any adjustments to the E&P from the foreign corporation. So if there's any kind of any kind of adjustments that are not taken into account on the Schedule J itself, you're going to wind up having an attachment and to the Schedule J, and that would be for line 6. For line 7, you're going to wind up reporting the CFC's E&P at the close of the tax year before distributions and inclusions for 951A and 951 Cap A. This is going to be for your Subpart F income and your GILTI. And then line 8 asks the filer or you to go ahead and include the gross income amounts of the U.S. shareholder, the amounts that are included for the U.S. shareholder for purposes of Subpart F and GILTI. And in line 9, you're going to enter those same amounts as negative numbers. Now, line 10, this is going to be if you have a reclassification. All right, so if you have a reclassification of section 959C2 PTIP to 959C1 PTIP. So this is basically if, remember we talked about this early on, if this is going to be Subpart F income, GILTI, or any one of those 5 other categories that in 1 year you had that was classified under 959C2, which is reclassified to 959C1, which is going to be investments in U.S. property, then you're going to have to go ahead and report that on line 10. Line 11 asks the filer to report E&P that was not previously taxed, that was treated as earnings and profits invested in U.S. property that was reclassified under section 959C1. And if that's the case, line 12 asks for a detailed description in the nature of the adjustments to E&P. Line 13 asks the filer to list any hovering deficit offsets from line D reported as positive numbers. And then line 14 asks the filer to state the balance at the beginning of the following year. Now, real quick, Schedule J, Part 2, there is an amount there basically reporting if you had E&P that was subject to recapture of Subpart F income in functional currency, you're going to have to go ahead and establish a recapture account if that wound up taking place. So basically, if the CFC has any access earnings and profits over the Subpart F income, then you basically have to establish a recapture account for purposes of reporting the excess Subpart F income for Part 2 of Schedule J. Okay, and that concludes my portion of the presentation.